Hello and welcome to Investors Hangout, your weekly guide to making smarter financial decisions. This series is brought to you by Aditya, Birla Sun Life Mutual Fund and Value Research. Now today we're going to discuss something that's relevant to each one of us, how to assess a mutual fund's performance. And we have with us Dhirendra Kumar to answer this and much more. Welcome, Dhirendra.
Thank you.
First up, when one thinks about mutual funds and investing in mutual funds, the first thing that comes to mind is the performance of the fund. But how does one really assess if the fund's stated objective meets our own financial goals or not?
The first step to investing is to aspire for more. That may be the starting point, but that may not be the right thing. The starting point should not be return at all. Okay. The starting point should be that which is the appropriate kind. If you choose the inappropriate vehicle, you will be in for a very nasty surprise. If you choose a liquid fund for your long-term investment, you'll be deeply disappointed. And that too after a couple of years. If you invest in a great equity fund for the very short run, you'll be disappointed. If you're a first-time investor and investing in a sector fund, you'll be disappointed. The problem is that when you look at the return, you are more likely to end up with the wrong choice. Looking at returns, recent past performance is the favorite pastime for most investors to start. And that will be a mistake for anybody to follow it blindly.
Once you have decided that, okay, this is the right vehicle for me to invest in, what is the next step there?
Next step is that, choosing a good fund. And choosing a good fund also, this is where most investors also falter. That look at the best performing fund in recent times and choose it. But the problem is that, if you choose based on that, more likely the scenario will be that things will turn around when you least expect it. You will be disappointed. And it may be inappropriate vehicle to begin with, and then you are choosing something, the outlier, which would have assumed great risk, which has been rewarded. So you will end up just taking the risk and not getting rewarded.
Recent performance should not be the only criteria to select the fund for yourself.
It's past. It's gone.
It's gone.
It's a rear view.
Okay. Then what should be the first step? How to assess the performance of a fund so that I can start investing in one?
I'm giving this framework based on, only for the equity fund, because for debt fund it is different. For hybrid fund it is different. And broadly I would like to classify that, these are only three funds. For index fund it is completely different. My first step for an equity fund is that it should have seen a full market cycle. A full market cycle meaning the market has gone up, a phase when it has gone up dramatically and it has gone down dramatically. And generally in a period of about 4 or 5 years, any 4 or 5 years, we would have seen a dramatic, surge as well as a decline. Like if you look at the market today and go back 5 years in time, in 2020, we have seen the COVID collapse, 30% decline in between. We have seen the surge as well. So if you take the period 2020 to 2025, you will get a phase when every fund fell, every fund did go up, and how they did in the fall and how they did in the rising phase. And if a fund has not been through a full market cycle, I would hold my opinion, because just looking at the rising phase and if it will actually collapse in the falling phase, I would like to be wary of it, or I would like to be aware of it. So that is one thing. Give it enough time so that it has been through this. Then comes beating the benchmark, and then comes beating its peers. Right. And if you have chosen a category, and if you have done these two things, and you have done it on a full market cycle, you will end up with a very limited choice, 2-3 funds only. So this is the framework for equity fund. By and large, I will follow a similar framework for hybrid fund as well. If a hybrid fund falls as much as the index or the ones which fall more, that is not my goal with a hybrid fund. I would like it to actually be a better shock absorber, something which provides a superior cushion. So I would like to look at hybrid fund differently. When it comes to fixed income fund, when it comes to funds which invest in bonds, there I would like to evaluate only on two variables, how it did when the interest rate go up. Or how it was able to anticipate well. I would like to evaluate the brilliance of a fund manager of a debt fund primarily on two things: that has he ever bought a dud? Because when it comes to bonds, when it turns bad, it goes down to zero. And it goes down to zero in no time. And The other variable on which a debt fund manager has to be evaluated, that how well he was able to anticipate interest rate going up or interest rate going down, and how he was able to prepare himself for it. If interest rates are likely to go up, and if he has reduced his portfolio's maturity to a point where it will be least affected by such fall, lower maturity, because shorter duration bonds will not suffer. Likewise, if somebody is able to leverage the flexibility of having longer maturity before the decline or before the interest rates are cut, and he's able to anticipate better. So, and it's a very difficult thing. It looks like it should be easy. No, we have seen it in the last 4 or 5 years that the Reserve Bank governor keeps surprising all the bond fund managers.
Right. Can you now elaborate more on how to assess risk-adjusted returns from a fund?
There is a body of knowledge which is rooted in efficient market theory, based on which the modern portfolio theory was devised. Efficient market theory assumes that every information available in the market is reflected in the pricing of securities. That's one. And second is that it can all be measured and captured, and there are different ratios based in which which is able to capture that. Sharpe ratio is one such thing. There is a concept of risk-free return, and there is a risk-free return. If you don't want to take any chances with your money, put your money in State Bank 45-day deposit. The likelihood of that going down is very low. So if you do nothing, you earn this much. So if you earn anything more than that, is it worthwhile for you to assume any more risk? If you invest and you earn just as much as the SBI's 45-day deposit, then it has all been wasteful. Because by doing nothing, you would have earned that much. So the whole idea is that, being rewarded for the risk that you assume. Now, there are two kinds of risk. One is that the whole modern portfolio theory, it defines risk as volatility. Something going up and down is referred as volatile. To my understanding, volatility is a function of noise, but that may not be a real cause of risk. The real risk is if you invest in a company and that company goes bankrupt. If you buy the bond of a company and that company goes bankrupt, it defaults on paying you on time. It stops paying you interest on time. That is real risk. Risk of impairment of your capital. Now, volatility and not getting your money back are two different things. If it is very volatile or the market has gone crazy, it goes down by 20%. But if you hang around for a long enough period, it will all come back. Because we have seen it over the last 100, 150 years that markets do get crazy and then they really make a big comeback. So based on this modern portfolio theory and efficient market hypothesis, there are a set of ratios, there are a set of process based on which some variables are calculated, and then we earmark them as risky or not. Sharpe ratio is one such thing. Sortino ratio is another. Alpha is another point, where how it has beaten the benchmark. Sharpe ratio is how it has done in relation to, it was a turbulent ride, but then it was well worth it. So based on which these things are calculated, but I think, it's very difficult for a naive individual investor to make sense of it. The simplest way for you to do is, look at our risk-adjusted performance rating. That is exactly, it's the Sortino ratio based 3-year in a category. That is something which people are able to relate. It's a combination of these variables which is captured in those ratings. I think it is very useful in terms of long-term evaluation. What I was telling you, that looking at a full market cycle, has it beaten the funds, has it beat the risk-free return, and how volatile it is, at the same time how it stacks against its own peers. Given the options. So you have all these multiple objectives you have to meet. You have to choose a fund which has done well over a full market cycle. That is better than looking at just 1 point return. Then has it been able to beat the benchmark? Has it been less volatile and been rewarding enough? And how it stacks up against its own peer, based on which these our star ratings are assigned and revised and updated. And I think that's a great starting point in terms of eliminating the options.
Right. So consistency over the long term is the key.
It's the key.
But let's talk about
consistency with performance.
Consistency with performance, right. Let's talk about the cost. How important is expense ratio or exit load when you're assessing the performance of a fund?
Exit load is actually a negotiable thing because in India we don't have real exit load. We have contingent deferred sales charge, what is called CDSC. This is the exit load, and exit load is a good thing. If you're a long-term investor, if I am a long-term investor, I would like to have a very steep contingent deferred sales charge in that fund because I get rewarded for somebody's misbehavior. What is contingent deferred sales charge? Is like an exit load if you exit within 2 years, if you exit within 1 year. And if you stay around for 1 year and more, there is no such charge, there is no exit load. So if you are a long-term investor and many other investors are short-term investors, every time they go away, their 1% is deducted and kept in the fund itself. And now SEBI has made it compulsory for all that exit load to be credited to the fund. So if you are in a fund, I am in the fund, and I hang around and you exit, your 1% will be deducted and it will be credited to the fund. So I might benefit as a result of your departure. Leave aside the load bit. If everything is equal, then expense is the only differentiator because expense is constant, performance is dependent on market, and if you get lucky with alpha, good for you. If you come across 5 funds which are just as good, choose the one which has the least expense.
Okay. All right. So Dhirendra, what would you say to investors who are struggling with decision paralysis, since there are so many funds to choose from, how to go about it?
No, one is that they have to really start with the assumption that they can't really find the fund which will be the best performing fund over their holding period. Because you have to hold it for the next 25 years. And how will you spot a fund which will keep doing well for 25 years? You have to broadly devise a mechanism that you'll be in a reasonably okay fund, if not the best fund. Because finding the best fund is impossible. Review your investment every 2-3 years. Be in a decent fund. And if it funds becomes very disappointing, give it 1 or 2 years, because every great fund also has a poor patch. And then be very objective in your evaluation, because there is a problem with most individual investors who are relatively new to investments, is that they really can't differentiate between market performance and the fund's performance. If the market has gone down by 50% and your fund has gone down by 20%, you are actually in a great fund. And if your fund has gone up by 100% and the market has gone up by 50%, even the person earning 50% will be happy, who has invested in an index fund. But you have every reason to be much more happier. So being able to differentiate that what you would have earned from the market anyway, what has your fund generated, and how it has been achieved. Has it been achieved by assuming much greater risk? If you really broadly understand what these things are, then these numbers are available on each fund in India at Value Research Online and updated every month. Look at it once a year, because these are numbers which will not change very dramatically. And if you take a look at it, these numbers every year to evaluate that should you act on any of the investment that you have. And that will be it. Choose some good fund, choose a fund which is diverse, choose equity for the long run, have those basic principles. And after that, learn to ignore the noise, because there will be 100 funds getting offered, being launched every other day. You will have the defense fund, you will have some other fund, you will have some consumption fund, innovation fund, whatnot. And they will have a compelling case. They will have a compelling sounding case. And only in future we will be able to figure out that it was compelling. And it is fine to miss out on that if you are into something which you understand and you will hang around.
All right, then moving on to the viewer's question now. Satish Jha is asking, for regular income, which debt fund is suitable?
Depends. What is your debt fund ladder? Have you invested in senior citizen savings scheme, post office MIP? What is the dependence? If you are looking for a long-term fixed income allocation, short-term debt fund is good enough. And even, and if you are trying to optimize return with a simple investment, maybe, the conservative hybrid fund, which is 70-80% debt and remaining in your equity, that could be another option. So I would say that look at this ladder. Guaranteed income, look at that debt. Government, post office MIP, senior citizen savings scheme. Discretionary debt, short-term debt fund. And if you're looking at beating inflation, not regular income, but fairly stable and superior return, consider those conservative hybrid funds.
All right, now there's another question on debt funds. This one's been sent by Viraj. He says, with decreasing returns and no indexation benefit, is it worth investing in debt funds for individuals in 30% tax bracket?
Yeah, there could be a very strong case for people in this highest tax bracket. The reason is very simple. One is that despite all that, it has become less attractive. Of course, the indexation was great, but there are two reasons why debt fund could still be interesting. One is that you are not liable to pay any taxes till you realize any. If you do a bank deposit, every year's interest income is taxable, whether you take it or not. It's still a very liquid and diversified vehicle, so the risk gets reduced. A bond can default, but a diversified portfolio of 100 bonds is unlikely to default at the same time. Third is that when I look at these hybrid structures, which are substantially fixed income, they are beautiful because they get you the benefit of fixed income. They are conservative. By their very character, they are fixed income. And by taxation, they are treated as equity. And that gets you the concessional 12.5% long-term capital gains benefit. So consider some of those. But I would say that, this tax deferral itself is a strong, and then over and above, all this, you earn superior return from many of these fixed income funds than deposits.
Thank you for tuning in. Keep watching this space for more information. If you like the show, do subscribe to our YouTube channel. Thanks for watching. Bye for now.